Welcome to Manager's EDU. In today's lecture, I will teach you the debt ratio. I will cover its definition, formula, example, and concept. So let's get started. The debt ratio measures the proportion of a company's total assets that are financed by debt. In simple words, it tells us how much of the company's assets are funded through borrowing. First, let's understand what assets and liabilities include. Assets can be categorized as current assets, like cash, accounts receivable, and inventory, fixed assets, like buildings, plants, vehicles, and equipment, intangible assets, like goodwill, software, and brand equity, and total liabilities include things like accounts payable, bonds payable, and other debts. Now, if the debt ratio is higher, it is not a good sign for the company because it means the company has more debt relative to its assets, which indicates higher financial risk. If the ratio is lower, it is a good sign because it means the company has less debt and lower financial risk. Let's move to the formula. Debt ratio equals total liabilities divided by total assets. Now, let's understand this with an example. Suppose a company has total liabilities, $400,000, divided by total assets, $800,000. So, the debt ratio in this example is 0.5. Now, let's understand what 0.5 means. It means that for every $1 of total assets, the company has 50 cents financed by debt. In other words, half of the company's total assets are funded through liabilities or debt. If you look at the proportion, the company's total assets are $800,000 and liabilities are $400,000, exactly half. So, the debt ratio of 0.5 tells us that 50% of the company's assets are financed by debt. If you didn't fully understand, you can watch this video again. Thanks for watching.